Let's welcome in Rahul Singh, Managing Partner at Ampersand Capital Investment Advisors. He is joining us from Mumbai. Mr. Singh, thanks so much for being with us at NDTV Profit. The markets have seen new highs today. The Nifty new high was around 91.22. Do you think it's playing out as per expected on the state election results, or do you think there's more room for upside? What would you do now?
Yes, I think it's played out exactly as anticipated. We were expecting a gap up for 1 to 2% kind of range, and yesterday we had got an inkling of that anyway in the SGX Nifty, so that doesn't come as a huge surprise. Markets, although at 9,000, 9,100 odd, is not exactly cheap right now, with Nifty trading at a price earnings multiple of about 17.5, 18 times. So from here on, we think that the movement could be more gradual. Of course, there is a huge wall of money. There's huge amount of domestic flows which are driving the markets, and FIIs have turned less negative than they were in January. So all that is supportive for still markets to continue to inch up. But obviously you can't get a repeat of days like today every day.
All right. What would you do here? Would you then, if the gap up has come as you expected, are you expecting consolidation? Would you book profits? What would you do?
Well, I think there will be a consolidation phase. Whether you book profits or not is going to be a function of what stocks do you have. And there are some stocks in the mid-cap space which are obviously going up much faster. There are some segments of the market which are no longer having the same fundamentals which they had before demonetization. For example, cement, we have become a little bit more cautious than what we were pre-demonetization. Also NBFCs, some pockets of NBFCs are still having to recover from the impacts of demonetization and how the informal economy recovers from that. So I think, so these are the two particular segments where we would, kind of book gains selectively. But as I said, I think these are large sectors. There is still an underlying theme of domestic savings coming into equities, which have so far absorbed all the FII selling since November. And I think that could continue to play out for the next 12 months. So we are bullish from a 12 to 18 months perspective. There's no going back on that theme. But in between we'll have pockets of volatility, we'll have pockets of uncertainty because GST is now going to be implemented, so it could have some implications on, again, not only the informal economy but the economy, from an inventory restocking point of view, it could have some impact on that as we come closer to June, July. But having said that, I think despite the fact that the market multiples are now at 18.5 times, I think the broad trend is still going to be pretty supportive and positive for the markets. So we would definitely not book profits with the intention of sitting on cash, if that's what you were trying to ask.
All right. So be patient. That's what you're saying. Where do you think people can look at investing even now, where they can make good money? Are there any ideas or stories there?
Well, I think we are obviously more bullish on specialty chemicals. The stocks have seen a fairly extended kind of a sideways correction or a sideways movement in that segment. We also like some capital goods companies which are now coming up and benefiting from the capex cycle. Also in the construction space and the ancillary space for construction, I think there is some momentum building up because of the order books, and therefore the outlook for them is improving. And all these companies are coming off of cyclical lows, so we see some potential there. Also, one segment which we like a lot is the wealth management and the financial services kind of space, where we like companies like Edelweiss and IIFL. I think these companies would benefit a lot from the tailwinds which we are seeing in the domestic financial savings increasing as a percentage of total savings. because the wealth management businesses in these companies are growing phenomenally well, and the profitability there has an inflection point as soon as you cross a certain amount of assets under advice. So there the valuations and the ROCs in those kind of businesses, in fee-based businesses, are much better than in the fund-based businesses. So I'm very bullish on we are very bullish on these couple of names in that segment.
So specialty chemicals, capital goods, even some of the financial names. What about some of those sectors or names that caught the investors' fancy since December? You know, we've seen good recovery in some of the housing finance majors or some of the NBFCs. Some of the auto stocks have also bounced back very quickly. The impact of demonetization wasn't as bad as expected. Do you think these will continue their up move, or would you be cautious?
No, I think there are companies like Maruti and Eicher Motors who are doing very well. I think the story of market share gains in both these companies is fairly strong, and we normally prefer to buy into companies where we are not just playing a sectoral theme, but also trying to identify bottom up if there is any case for these companies to outperform the sector. Having said that, I think the companies and the stocks are not cheap. These stocks which I mentioned, they are all in the fairly to fully valued kind of a range. So one would like to be buying them on declines and selling them on outperformance beyond a certain valuation, which is how we would like to play Maruti and Eicher Motors. These are the couple of names we like in the segment in the large cap space. So that's how that's our view on in autos which you mentioned.
What about the housing finance companies? Do you think the government has already stated housing for all is the aim that they have, and of course the interest subsidy also given to particular ticket size of housing loans given. Do you think housing finance companies are also ones that will see strong growth? So the up move will perhaps in prices will justify the valuations and the earnings expected. What would you do with housing finance companies?
Well, housing finance as a segment is obviously facing some headwinds in terms of margins and in terms of competition from banks. So we are not that optimistic about the margin side of their business. Of course, the AUMs are still growing, especially the ones which are focusing on the affordable housing and the smaller ticket sizes like Canfin, Repco. These companies are going better than the companies which are only in the metro space or targeting higher ticket sizes. But having said that, I think all of them are going to be facing some margin challenges. We all saw their margins expanding over the last 2 years, but now I think we are beginning to see a period where banks are getting more aggressive. There is more liquidity out there. And there's more competition for housing finance, because in this whole era of post demonetization, that's one segment which is obviously the least risky, and market is rewarding that. So I don't think there's too much of money to be made there in housing finance as far as I can see.
All right. Then if investors are holding these companies, would you then suggest they book profit, deploy elsewhere, will then make money, or continue to hold with a longer term perspective?
No, so from a longer term perspective, obviously things turn around because these interest rates are supportive for housing demand and so on. But there are so many moving parts that I would not want to, if someone has a 2-year horizon, yes, of course, these companies which especially with good management, some of the names I mentioned would continue to do well. But you have to make a choice here and say whether I want to be in those companies or I want to get into companies which are seeing acceleration in growth in the next 2 years. And those are the companies which I mentioned, whether it's Edelweiss or IIFL or JM, the host of them which are benefiting from the whole wealth management wave which is taking over the earnings for those companies. So really the choice is between whether you want to stick to high quality but maybe moderate growth over the next 2 years, or whether you want to move into the more emerging segments of financial services, which is what we would recommend, to switch partially from the housing finance companies to these kind of names.
What about then the traditional banks? Do you think they offer a good investment? The bank Nifty has made a new high. Any of the banks that you like, maybe PSU banks, if you think that the NPA resolution is partly expected, their valuations look far more attractive than the private sector banks. Anything in the banks that you like?
Well, I think we are okay to miss PSU banks for the first 10% move because, I think there have been a lot of false alarms or false kind of excitement which has been created in the past. As long as we don't see a good visibility of whether the banks' NPAs not coming down significantly or the slippages coming down. We have seen a period where the slippages have become stable quarter on quarter, but they're still not coming down. Secondly, we have still not seen credit growth going up. So very, very importantly, I think the whole talk about bad bank and what kind of benefit it creates for the banking sector, I think we are waiting to see and watching that more carefully. From a valuation point of view, I totally agree with you. The corporate banks are now offering much more value than the other retail-focused private sector banks. So there is definitely a case in 2017 to be focused on this sector. As of now, I don't think we have reached a stage where we can conclusively argue that PSU banks or the corporate sector banks, whether in the private sector, would outperform the rest of the sector. I think there are still some milestones to be crossed, as I mentioned, before we take that call.
Rahul, you mentioned earlier that you would be bullish on the markets for the next 12 to 18 months. But again, dips would be buying opportunity. Right now, what we have seen in the last few days, do you think it can be called a euphoria sort of a phase?
Well, you can say that, but euphoria can be much wilder than what we have seen. We are still not in that out and out euphoric stage, in my view. Obviously, leading up to the elections, the market had rallied, so there was a decent amount of probability of election results being in BJP's favor was already factored in the valuations. So what we are seeing today is just the culmination of that trend or of that event per se. I think going forward, there are a lot of events to watch from the Fed. There are events to watch on the inflation side. There is GST. Earnings in March may not be that great because, the relief which we saw in some of the companies in the December quarter results, the March quarter results, we are continuing to see some slowdown in those segments. So there are these negative factors which right now the market seems to be completely ignoring. Which will probably temper down the move and also make it much more gradual and maybe a little bit of a pullback from here. But short-term moves are very, very difficult to predict and project. So therefore, I would not venture out and stick my neck out on what is the index level I see in March end or something like that. But I think the overall trend from a 12-month perspective, I don't see any problem in that, and I think election results obviously gives a strong support to that view rather than a short-term view, but it gives a strong support to the long-term view on the markets.
Right. As far as EM capital flows are concerned or flows into India are concerned from FIIs, after the election, people would build in a much more stable government, or already people were expecting a stable government and that's why this just comes as a big relief?
No, I think there is, at the margin, there is going to be much more of continuity benefit which the Indian markets will get from an FII flow perspective. But as I said earlier, we don't need the FII flows to be very strong for the markets to do well. We only need FIIs from being huge net sellers to become neutral on India. And that is enough because we have huge support from the domestic savings and domestic flows in any case. And that might actually put off some FIIs, some more value-focused FIIs, or not coming into India in as much force as they would have otherwise. So I think on the whole, I think at the margin, the assessment of Indian markets will definitely improve. Commodity prices are also easing off. Crude is down 10% from its recent peak. Which helps markets like India because we are a crude import dependent economy. So all those tick marks are falling in place. But these are, as I said, these are small tick marks in favor of India. I don't think overnight you will see huge FII inflows, and we don't need also overnight huge FII inflows because that is when bubbles can get created if you have huge FII inflows and huge domestic inflows. ideally one would not want to go there so quickly.
Right. You mentioned about Fed earlier. What would be your view on Fed and dollar index? Is that one of the biggest risks for the markets? What happens from US?
Well, yes, I think more importantly, what commentary Fed gives beyond the 25 bips hike, which now seems to be pretty much consensus. What commentary they give going forward on the way they will look at a lot of data which comes out in the US and the way they will treat 2017 as a continuous rate hiking cycle. I think that's more important. I think there is obviously a risk that Fed might incrementally turn more hawkish in their commentary, and that might not be very positive for the emerging markets. But I think at the margin, if India manages to get its fair share of FII inflows or reduce its share of FII outflows, if there were to be FII outflows, then I think we are kind of, it's difficult to say that we are totally insulated, but we will be relatively insulated compared to rest of the emerging markets.
Right. As far as sectors are concerned, you mentioned about certain sectors which you like, but they are more of a bottom-up ideas. But do you believe that pharma, private banks, these are names which always tend to attract buying? So today also you saw markets going up, you saw allocation to cement. So private banks, cements are probably the best way to play the index?
Yeah, our approach has not been to really play the index per se, which is why we focus on bottom-up ideas even within these sectors. And even within banks, if we start liking banks, and I think we are at a stage where at least the valuations are supportive, we would like companies, we'd like to advise our clients to buy companies where there is a bottom-up trajectory or a bottom-up case for improvement or something more happening at the granular, at the company level, rather than taking a call on a very macro basis. So that's something which we have focused on. I think the FII inflows or the domestic large fund inflows, when they obviously deploy first in the index funds because that's the easier way to deploy, more liquid. So there, companies like, companies obviously like private sector banks, pharma, I'm not very sure, but private sector banks obviously fall in that category.
Right. As far as pharma and IT are concerned, what will be your view over there? You think valuations are coming in an attractive zone?
IT, yes. Pharma valuations are still not what you could call value because there are risks out there in generic pricing in US and what Trump might do in terms of the drug pricing there. So pharma, we are not in the valuation zone, buying zone. In IT, yes, the valuations are kind of quite reasonable, and especially given that a lot of companies are sitting on cash and are not doing buybacks, it is providing some kind of a base or a support to the valuations. The H-1B visa, whatever new rules come out is a risk to profitability, but I think the valuations are partly factoring in that anyway. But as I said earlier, I think our effort is to always try and identify companies which are coming out of their own trajectory of improvement or their own bottom-up kind of drivers of earnings rather than focusing too much on the sectoral trends. So one of the companies which we liked over the last 3 to 6 months was Tech Mahindra. Of course, now it's moved up to what we thought was the fair valuation range. But I think those are the companies where we think there is going to be sectoral outperformance, and that's where our effort is.
Right. In terms of mid-cap valuations, what would you say? You mentioned about specialty chemicals, cap goods, brokerages, names that you like. But what would you say about the overall mid-cap valuations? As soon as domestic equity starts to come in further, you expect valuations to increase more from here on?
Well, I think the valuations are getting supported purely by that. So it's a very difficult call as of now, and I don't have a clear answer for that. Because the companies obviously there are companies which are doing very well, but now trading at multiples which you would probably ascribe to large cap companies. Of course, a lot of it is getting driven by the growth outlook in these companies relative to the large cap companies. But having said that, I think there are areas where the valuations have become quite excessive, and you are seeing that even in the mid-cap funds, a lot of the fund houses have stopped subscriptions or have limited the the inflows in their schemes, and that's purely because they are not seeing any immediate investable options of the kind of money which they're getting. But it's not just just not the domestic fund, it's the PMS and a lot of the schemes which are there, which are getting a lot of inflows. So I think the tendency of the market would be to keep going lower and lower in search for value and stories. And I think that trend will continue in the next 6 to 12 months.
As far as telecom is concerned, real estate is concerned, these are sectors which nobody wanted to touch. Let's start with telecom first. Interesting M&A happening in the sector. I think it could be one of the biggest sectors that could give returns for a lot of investors. Maybe Reliance is also something which you can include in that.
Yes, telecom is seeing a renewed activity also because the returns from the sector had not been great, and also the returns on the investment which the operators had made had not been great. So we've all reached a point where the operators have to sit back and think as to why they are in the business, and that's what is happening in the case of Vodafone Idea merger or the proposed merger rather, because the merger has still not been announced. But I think the trend is very clear. We will have only 4 operators by end of 2018 maybe, because this merger itself will take time. But I think next 6 to 12 months is a weak period for the sector because the profitability will not be great. Reliance Jio's offers have been matched by the operators, by the incumbent operators, and this cycle could repeat one more time, in the sense we could see one more round of price cuts. But I think the stock to own here would be Bharti more than Reliance or Idea, because Bharti has also shown its intent to exit Africa, which has been a huge drag on its profitability and balance sheet. Our view is that they are on their way out gradually from Africa. If you look at their actions, they have never said it, but if you look at the sum total of their actions, they are on their way out. And that releases a lot of capital to focus on the domestic market. And from a bandwidth perspective and a network perspective, they are much more ahead. They're much ahead compared to Vodafone and Idea, at least, to compete with Reliance Jio.
In terms of Reliance, not of course commenting on the stock, but what happens with the Jio strategy is the key driver for the stock, how they make money, what they do about their capex that they've already spent. Do you think they are getting very, very aggressive at this point of time?
Well, yes, I think it's a decision which they have made to invest for next 10, 15 years. But from a shareholder's point of view, who's wanting to get returns in the next 2 to 3 years, it might be a little tough to expect too much returns from that investment which has gone into Reliance Jio, because the scale of investments is right now totally out of whack with the size of the market, if you will. And the size of the market which they assess and their ability to take market share is contingent on how the other people shape up. And if Vodafone Idea merge and Bharti is there, so you have a strong 3-way contest for that market share. So it's difficult to see them getting beyond 20-25% market share in that scenario. So with that, and with the kind of investment and the fact that market might actually shrink in the next 2 years before going up, the near term or the medium term returns from that investment from a shareholder perspective looks to be a little difficult. Of course, market looks beyond that and starts to factor in from a very long term perspective, especially for a stock like Reliance, which is a large cap rate. So you start to give more benefit of doubt to large cap rate companies like Reliance. But if it were a listed company, it's difficult to see. If Reliance Jio was a listed company, it would be difficult to justify the valuations which probably the market is already ascribing to Reliance Jio in the sum of the parts for Reliance.
What do you do with organized retail? With the response that one saw in DMart, do you think organized retail is one of the best sectors at this point of time? We've seen it with aviation earlier when Indigo came out with the IPO.
Well, I think the organized retail, there was easy money to be made in some of the companies like Future Retail and V-Mart and so on. But I think that opportunity is gone. I think these stocks are now trading at 20 to 25 times EV/EBITDA. Of course, DMart might list at 30 times EV/EBITDA, but it's a far superior company and with far better prospects in terms of the growth and the way they are managing growth without sacrificing on margins or balance sheet. is just a phenomenal story. But I think that part has played out. We would not be chasing these stocks at these valuations.
Right, but you know what happened with Interglobe Aviation, how Jet, SpiceJet re-rated? Can some other retail names also get re-rated? Because you know you can't have such a big difference between two large cap retail companies.
It's already got re-rated. I mean, if you look at the companies like V-Mart and Future Retail has more than doubled in the last 3 months. So it's already re-rated significantly. I don't see that continuing in just because DMart is going to get listed in a few days. I don't see that continuing because the fundamentals are very different between DMart and the rest of the companies. The models are very different. The management track record of DMart is very, very different from the track record of the other listed retail plays.
Rahul, thank you so much for taking out time for us. Always good to get a perspective from you. That was a view coming in from Rahul Singh.